All right, Brew Crew, welcome back to another episode of the Trade Retrospective. As I mentioned yesterday, we're going to talk about the QQQ trade today. So let's start off by discussing what was happening on the time of entry, which was Thursday at around 9:10 a.m. Pacific time. This is a snapshot of what the Qs looked like at that moment. As you recall, there was a pretty sharp sell-off in the morning. Tech was seeing a massive pullback. Now, when I was looking at the chart, I realized just how sharp we were moving down, and I had a hunch that 20 MA was where the Qs wanted to pull back to. So I wanted to capture a move into that area, but looking at how Qs behaved previously on pullbacks to the 20 MA, I noticed that what it would tend to do is break a bit below that and then bounce back above. So seeing that pattern and thinking that it would happen again, I actually started looking to target something lower than the 20 MA. And the next safest zone that I felt okay to target was the 50 MA down here, which at the time was around 268.50. Now, knowing that I wanted to capture a move into that zone and knowing that I didn't want to pay a debit for this trade in case I was wrong, and knowing that the premiums in the puts were pretty pumped up from the rise in volatility, it was clear that a good structure to put on under these circumstances was a wide put ratio. Because of the increase in the premiums, I'm able to widen the distance between the legs of my ratio, which allows for a larger potential profit zone. So I headed over to the options chain with the goal of having the short puts of the put ratio spread around the 50 MA. At the time, the short 267 puts were trading for about 13 cents, which was decent given that the Qs were still around 290. From there, I looked backwards to see which put I could then buy to make the put ratio nice and wide and yet still get a credit for or even pay just a small debit for. And that turned out to be the long 275 put. So ultimately, I ended up looking at a 275, 267, 1/2 put ratio, which was going for a 1 cent debit. Now, as I was looking at this structure, I started realizing how good of a trade this was because, first of all, the odds that the Qs flush below the short puts in the span of the next 24 hours I thought was pretty low. Sellers would first need to contend with that 20 MA, which would probably first get a bounce on Thursday if we got there, and then on Friday, we would have to continue the flush, and even if we reached the 50 MA, I would still have 8 more points below the 267 short puts before my break even is reached, and that is at QQQ 259. So there was plenty of room for me to work with. Okay, and the second reason why I like this trade is that I thought if the Qs closed around the 20 MA on Thursday, how far could it go down the next day at the open? I am, somewhat protected by the 5% limit down in the overnight session, which means that the market could only open at most 5% below the 20 MA and no lower. With the 20 MA at around 282, a 5% drop would put the Qs at 267.90. This means that the 275 puts would be deep in the money, and the 267 puts would be slightly out of the money. Yes, the premiums would be pretty jacked up from the volatility expansion, but I still would have a chance to get out at a decent profit, volatility considered, right? So those two reasons were why I thought the put ratio made sense, so I entered it at a 1 cent debit, and from there I closely monitored the trade. What I didn't want to happen was for the Qs to tank hard into the close, because that would probably mean I would need to butterfly off the trade just in case of a flash crash the next day. But taking a look at the close on Thursday, we could see that the Qs basically traded mostly sideways to slightly down and closed the day at around 287. So that was perfect. That actually means that I can handle a 7% move lower the next day, and 7% down is the first circuit breaker level, and that puts the Qs at around 266.91, basically puts my shorts at the money. So fast forward to the next morning as the Qs began selling off again, I was watching the spread expand. At 7 a.m. when the Qs were trading at about 281, which is still well above the long put, the spread had already expanded to about 32 cents. I took off the first piece there because that was just slightly under the 20 MA, and remember a breach below the 20 MA was what I was expecting to see and where I was looking to lock in some profits. And I was thinking that a bounce from here would drastically contract the spread, so I wanted to at least harvest some profits and lock in a 30x gain on the initial debit. But within the next 30 minutes at around 7:30, the Qs had sold off even more, and pretty soon my long puts were in the money with the Qs trading at 274. Of course, this sharp drop also increased the value of the short puts, but overall the put ratio still expanded in my favor, and I was able to close another piece out for about $1.27. That's 127x off the debit. From there, that was pretty much the low point of the day, but as the Q started bouncing and then started trading sideways shortly after, this put ratio continued to expand as the premiums in the short puts just got sucked out really fast. And at one point, I even remember seeing this trade for almost $2 or so, which is wild wild if you think about it, because that's 200x the initial debit. Anyway, the Qs pretty much then drifted higher throughout the rest of the session, and I closed more of the put ratios at $1, and then a couple hours later before the close, I just closed the last piece for about 26 cents. Overall, the trade I think was a home run. Obviously, this trade really only made sense to put on if you are able to get off a really wide distance between the long and the short legs, and this typically only happens if the volatility is more inflated than usual, which was the case here. Depending on one's, own risk tolerance, this ratio could easily have been a wide butterfly instead, or let's say you don't like the 1x2 because there's only one long in front of the short 2. Well, instead of a 1x2, what about a 2x3? With additional long options in front of the short options, yeah, you'll end up paying a little bit more in debit, but your break even gets pushed out even further and your maximum potential increases as well. So maybe it's worth the additional debit. If I didn't mind paying more for a debit, I probably could have bought a 2x3 or a 3x4 ratio on this, or even just buy a vertical. Just to make this a bit more concrete, as an example, had I done a 2x3 ratio in here in the Qs, the cost per spread would have been slightly higher. The math works out to about, 15 cents total debit per spread. And on Friday, at the time that I sold my second lot of the 1x2 ratio for $1.27, at that time, a 2x3 ratio would have been worth roughly $3.22. So if you were willing to lose a 15-cent debit per spread to make $3.22, you totally could. That's still over 20x, which is great. And you wouldn't need to worry about, having only one long option in front of the two short options, as is the case with a 1x2. And you can put on more size because your break even is further out below, right? Because instead of having one long vertical to push the break even lower, you now have two long verticals to push that break even lower. Just imagine if you did a 3x4 or a 4x5, how much further the break even would be. But of course, the debit would be significantly higher because at that point, it's just basically having a bunch of verticals. So yeah, think about adjusting the plays to your own level of comfort. It doesn't have to be done the way I do it. It doesn't always have to be put on for a 0 or for a credit. I know I put on a lot of these trades with little to no cost, and I finance a lot of my plays here and there. And I'm sorry if it gives off the vibe that you can't put on any plays unless it's super cheap or that you have to get paid to trade. That's not at all my intent. What I really wanted to show you guys is that, hey, it's okay to reduce the cost a bit here and there, or as much as you want, as much as you're comfortable with, It doesn't always need to be naked long calls or, long puts, but at the same time, it doesn't always need to be a 1x2 or broken wing butterfly. It could be a 2x3 or a 3x4 or, a 3x5, even straight up verticals. What about calendars, diagonals, ratioed calendars or diagonals? Just know what risk you're okay with, what debit you're okay with paying, what size you're okay with, what break evens you're okay with, how you're going to progressively harvest profits, how you're going to manage the debit of the entire trade over time, and of course, how you're going to adjust to reduce risk when the time comes. All right, but that's it for today. I hope this video was helpful. If you like this kind of trade, we do these types of plays all the time, so feel free to join us by checking out the links to our available channels down in the description below. It's all free. All right, we share our thoughts and trades and setups, entries, exits, all that good stuff, all that good commentary, all those good vibes. Hey, we brew up really awesome trades, okay? But for now, stay safe, Brew Crew, and we'll catch you in the next video. Cheers.